The housing market variable that nobody is talking about has to do with the Federal Reserve. Now, everybody talks about the Federal Reserve's interest rate, right? They're going to lower their Fed funds rate, which is going to bring mortgage rates down and help stimulate the housing market. And while that is true, what people aren't talking about is the Federal Reserve's balance sheet. See, over the past 15 years or so, the Federal Reserve has bought mortgage-backed securities on the secondary market, which has kept interest rates below around 5% up until recently when they stopped purchasing mortgage-backed securities and started reducing the size of their balance sheet. So in this video, we're going to break down exactly what the Federal Reserve did, what they're doing now, and what we would need to see take place for the Federal Reserve to start purchasing mortgage-backed securities again, which would bring mortgage rates down below 4%, which I know they're at around 7% now. I truly believe that if the Federal Reserve doesn't purchase mortgage-backed securities, we will not see mortgage rates come below 4% again. So this is important stuff to think about. Before we get into it, my name is Liam O'Reilly. I'm a realtor in Vermont with Jerry Riley Real Estate. If you have any real estate needs, all of my contact information is in the description. I'd be happy to help you. Reach out to me directly. All right, so let's get into this video here. So the Federal Reserve's balance sheet. This is a updated chart. We see here the Great Financial Crisis. They had a little bit on their balance sheet, and then it skyrocketed after the GFC, continued to increase slightly, and then increased in the 2010s, remained flat for a while, started to decrease, and then boom, the pandemic happened. All that stimulus went into the economy. They bought U.S. Treasuries, they bought mortgage-backed securities. The interest rate on mortgages dropped significantly to under 3% for the most qualified borrowers. And now we see they've been reducing the size of their balance sheet. Now we're basically at the levels that we saw right after the pandemic, and it continues to reduce. So let's take a look at exactly what they've been doing. So if you go onto the New York Fed's website, the Federal Reserve Bank of New York, the desk is what conducts this operation, conducts the purchase and sale of mortgage-backed securities. And you can take a look on exactly what the Federal Reserve is doing. We see here, the desk plans to conduct approximately $81 million in agency MBS small value purchase operations over the period beginning on May 29th, 2024. So I just said they're selling their mortgage-backed securities. They're letting their balance sheet run off. But here, they're buying $81 million in mortgage-backed securities. So how can that be possible if they're reducing the size of their balance sheet? Why are they buying mortgage-backed securities? Well, they want to let their balance sheet run off at a controlled rate. They don't want to let their balance sheet run off too fast or too slow. So they have a goal, the rate of decrease in their balance sheet. And if they look at the mortgages that are maturing, right? If you have a 30-year fixed rate mortgage, you pay that off completely. That mortgage is matured and paid back to the Federal Reserve and is no longer on their balance sheet. So if they take a look at all their mortgage-backed securities and more mortgages are maturing than they'd like, and it would reduce their balance sheet too much, they'll purchase some mortgage-backed securities. So they're still reducing the size of their balance sheet, but they're doing it in a controlled way at a controlled rate that they have decided. I don't know exactly what that rate is, but that's what they're doing, and that's why they're buying mortgage-backed securities in their most recent operation. And we see here they have sold mortgage-backed securities in the past. The desk plans to conduct $74 million in mortgage-backed securities small value sale operations, right? So they weren't the MBSs weren't maturing fast enough to meet the Federal Reserve's goals, so they decided to sell some to catch up to the rate of decrease in the balance sheet that they're shooting for. Now, this might sound like a lot, 81 million, 74 million, but in the overall U.S. housing market, these are really pennies. It's not making a huge dent in the housing market either way, and at the same time, they're still lowering their balance sheet. If we take a look at what they were doing in 2022 here, 2021, I just scroll down a little bit, you see here, they have a ton of historical data on this. The desk plans to conduct approximately $54 billion in agency mortgage-backed security purchases over the period beginning on July 29th. I don't know if my head's cutting it off or not, but that is what I was reading there. We see 54 billion, 44 billion, 54 billion, 51 billion, 56 billion, all in purchases during the pandemic, right? This was the stimulus that drove mortgage rates down, was not only the Federal Reserve dropping their Fed funds rate, but them purchasing mortgage-backed securities. And if we take a look back at their balance sheet here, so right, that the era that I was talking about is this increase here. They're increasing their balance sheet. They're buying mortgage-backed securities. They're trying to stimulate the economy. What about when the market was flat here? You see, or not the market, but their balance sheet was flat. They were maintaining the size of their balance sheet. And now something to note is that this balance sheet, it's not just mortgage-backed securities. This is their total assets. They do have a chart of their mortgage-backed securities, but what we're looking at now are mortgage-backed securities and U.S. Treasuries. So these are their total assets. Now, let's take a look at what they were doing during this section, 2014 to about 2017 here. We'll scroll down to 2017-ish. Here we go. 2017, the desk plans to purchase a maximum of 11 billion, 12 billion above that, 13 billion, 11 billion, 8 billion, 12 billion. So they were still purchasing mortgage-backed securities in order to keep their balance sheet stable. Oop, wrong chart there. In order to keep their balance sheet stable and flat, not increasing or decreasing, right? Because these mortgage-backed securities, they're maturing. People pay off their loans. People sell their house. Then at that point, the mortgages in the mortgage-backed security become due, and they're no longer on the Fed's balance sheet. So as those mortgages mature, they need to buy additional mortgages in order to keep their balance sheet stable, which is what they were doing in 2014 to about 2018 or so. Now let's take a look at the 30-year fixed rate mortgage during that time. So we see here when the Federal Reserve was buying these mortgage-backed securities, right? We see that on the Fed desk, and you can go back and look at this yourself. The link is in the description. You can take a look at previous years. I'm not going to dive too much deeper into that, but when we see the Federal Reserve was increasing the size of their balance sheet and maintaining the size of their balance sheet, the 30-year fixed rate mortgage, right, when they were increasing it was at around 4% or lower, 3%. It was at under 5%, under 5% from, let's see, when was the last time it was above 5%? From 2010 up until, let's see here, doing this in real time, up until 2022. So for 12 years, when the Federal Reserve was purchasing mortgage-backed securities, the mortgage rate stayed under 5%. Now, when we take a look at what they're doing now, obviously they're reducing the size of their balance sheet. Even though they're buying small portions, we're talking about millions of mortgage-backed securities as opposed to billions like they were doing in the past. We have, when they're reducing the size of their balance sheet, essentially stepping out of that mortgage-backed security market, we have interest rates at around 7%, right where they are now. 6.95 is what the Fed is telling us, the St. Louis Federal Reserve Bank. Now, unless the Federal Reserve starts to buy these mortgage-backed securities again, then we're not going to see mortgage rates drop below 5%. Now, we might see mortgage rates drop to, say the Federal Reserve brings their Fed funds rate down to 0. We could see mortgage rates come down to around 5% or so, but I don't think we're going to see it drop below 5%. Certainly not below 4%. We're not going to see mortgage rates in the 3s unless the Federal Reserve buys mortgage-backed securities, because the investors, the people that are buying mortgage-backed securities that are not the Federal Reserve, they need to get a return on their mortgage, and they assume risk, right? When you get a loan, when somebody gives you the money to purchase a property, there's a risk that you are not going to pay that money back and you are going to default on your loan. Now, the Federal Reserve, they don't care about getting a return. They don't care about the risk that's taken. Their job is to help stimulate the economy. So because they don't care about a return on their mortgage-backed securities, they can buy it up at whatever interest rate it is. Now, other people do purchase mortgage-backed securities along with the Federal Reserve, even when rates are low. But the Federal Reserve buying these mortgage-backed securities is what drives rates down, because there's competition, right? If it was a free market like it is now, where the Federal Reserve is not purchasing many mortgage-backed securities, the investors have to assess the different bonds out there, right? Which is why the 30-year fixed rate mortgage is so closely linked to the 10-year Treasury, because many of the people investing in the 30-year fixed rate mortgage, these mortgage-backed securities, also invest in the 10-year Treasury. So if the 10-year Treasury is offering a higher rate of return, they're going to demand a higher rate of return from their mortgage-backed security. But the Federal Reserve, they don't care. They are not in it. They're not a profit-making machine. They're in it to keep the housing market moving. So if we see the housing market completely stall and we see economic conditions start to worsen, then the Federal Reserve might try to stimulate the economy, not only by dropping their their Fed funds rate, but by purchasing mortgage-backed securities in order to help stimulate the housing market, drive more building, which would create more jobs, more sales, more transactions, more money flowing through the system, which would help stimulate the economy. Now, that's not something that they've been talking about at all recently. They've only been talking about lowering their Fed funds rate. So as far as I'm aware, they're still planning on reducing the size of their balance sheet. And as long as they're in that zone, I don't think we're going to see mortgage rates drop below 5%. Now, we could see mortgage rates at around 5%, or maybe even, slightly below 5% in the high fours if they drop their Fed funds rate significantly. But the big driver that kept mortgage rates below 5% for so many years, if we take a look at this chart, for 12 years, the big driver was the Federal Reserve increasing their assets, increasing their balance sheet, and purchasing mortgage-backed securities. So that's something else to note if you're in the housing market right now and you're expecting mortgage rates to drop to below 5%, to below pre-pandemic levels. We need the Federal Reserve to purchase mortgage-backed securities. Otherwise, we're just not going to see it. So anyway, thank you guys so much for watching. I really appreciate your support. Leave me a comment. Let me know what you think, and I'll see you in the next video.